Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching the channel. I greatly appreciate it. This week up, we're going to take a look at Alphabet, the owner of Google, YouTube, Android. Let's figure out how much money, cash money, Google generates on an annual basis. We'll look back 10 years to figure out what they've been doing historically. We'll look forward 10 years to figure out what they're going to do. And if we bought the stock today, now that it's down 30%, what can we earn by buying the stock? You ready? Let's get to work. Okay, like we always do in this channel, we're going to evaluate Google on the 5 key attributes. Those are, number 1, top line revenue growth, got to have it. Number 2, EBITDA growth, earnings growth. We want to see earnings growing at the enterprise level. Number 3, strong free cash flow, kind of the model of the show. Number 4, low debt, less than 3 times debt to EBITDA. And Number 5 is a well-priced stock. Now, what is a well-priced stock? It's a little subjective, but basically we want to build a conservative growth portfolio that if we bought the stock today and held it for 10 years, we would beat the market, or at least that's the assumption on the underlying return. That is a well-priced stock to us. We use those 5 key attributes as the foundation for how we look at stocks, and then there's obviously more due diligence you have to do, but at least it helps separate some of the stocks out there. Remember that building a key portfolio is a subtractive process. It's not an additive process. You're basically removing any stock you can to figure out what's left, the very few, the best of the best, the absolute cream of the crop that you add to your portfolio. That's what you want to own. Let's figure out if Google meets the test. Now, I want to encourage you to always read the 10K. You should read the 10K for every stock that you own in your portfolio. What that's going to do, it's going to limit your portfolio. It's going to focus your investment dollars into the very best ideas that you have, and you're going to read those 10Ks every year that you own the investment. Now, behind me is the first quarter results for Alphabet. I'm going to call it Google, but it's Alphabet going forward, because I want to get a feel for what they've done the very first quarter of their fiscal year. And what you're going to see here is actually very, very good results. Q1 saw strong growth in search and cloud. We can see that revenues for the quarter of 2022, $68 billion, up from $55 billion the same quarter last year. That's a growth rate of 23%. Also, operating margins, 30%, consistent, very, very nice. Google, a great start to what has been a very, very troubling year. And I wanted to make sure that at least the first part of the year hasn't collapsed like a lot of other businesses have readjusted their earnings. Google looks to be like it's holding its growth trajectory. Let's figure out what to do now. All right, let's dive into the historical revenues and earnings of Google. Now, behind me is 9 years of historical revenue from Google. All these are in millions USD. And it's the end of their fiscal year, December 31st. So 2013, they made $55 billion of jack in one single year. Next year, 66, 74, 90, 110, 136, 161, 182, 110, 257. That's $250 billion, by the way. I'm going to take a little sip of Belvini Scotch just to say thank you for Google for the $250 billion of revenue. EBITDA is enterprise level earnings. So what we're basically doing is we're saying, give me the steady state earnings. Strip out the change in currency. Strip out closing out of divisions. Switch out interest income. I don't want to see that. Depreciation, amortization. I want to see the basic kind of ordinary income plus depreciation and amortization, which is a non-cash expense. So I want to see what is that levelized for the enterprise. If that's growing, that's a business we're interested in. Many businesses nowadays will manipulate the earnings per share by buying back shares and showing earnings per share growth simply by eating up or lowering the denominator. And we don't want that. We do want it, but we want a business that's growing on its own, then have them do a share buyback program. We'll get there in a second. Let's keep going here. I'll keep going. But at the end of the last year, they produced $91 billion of EBITDA, which is absolutely amazing. That is a 21%, is this right? 21% annualized, that's the same digit, that's interesting. 21% annualized consolidated annual growth rate, CAGR, for both EBITDA and revenue. Outstanding, Google. Okay, now let's take a look at the enterprise value of Google. And what we're going to do with that, we're going to start with debt. Short-term and long-term debt, $6 billion to $28 billion. That's a 4 times growth rate, but who cares because earnings have grown from $20 to $90 billion. They can absolutely afford this debt. In fact, they have so much excess cash on the balance sheet. That's $118 billion of just excess cash. That doesn't count the billions that they have in their checking account. This is cash that's piled up so big in the checking account, they've put it into treasuries and just sitting on the sideline. And so what we're going to do is we're going to net these two, and they have a positive cash balance, which is fantastic. The market cap is average shares times the average price. For the year, I get $366 billion back in 2013, and that has grown to $1.9 trillion, just shy of $2 trillion by December of 2021. I add up all of that, and I get the enterprise value, which is basically the same. Because cash and debt net to zero, these numbers are going to be very similar. So it's basically the same thing. Let's go over to our ratios. The first one I like to do, net debt to EBITDA, which is our kind of bankruptcy risk. Now, I got a lot of flack on the channel last time when I said bankruptcy risk. Obviously, there are multiple different ratios that you can use to judge bankruptcy, and ultimately it comes down to the pure cash money that you have to pay the bank back. EBITDA is not pure cash money, but EBITDA relative to debt is a metric that banks use. They set it in covenants when you borrow money, so it's a very relevant metric. Also, banks will typically lend 3 times debt to EBITDA to an institution as a senior level of debt. We do not want businesses that have junior level of debt. It's very, very expensive. But as you can see here, these are zeros because their cash is so large, it swamps the debt, and there's no debt at all. Now, enterprise value to EBITDA. This is essentially how many years do you have to own the stock, assuming zero growth, to get your money back, or at least have the business earn enough money to pay for itself. That's a phenomenal way to judge risk. When do you get your money back, right? Return of principal is the first rule of investment. Then you get the return on principal. So the very first thing we want to do, we want to make sure we're buying a business that has positive earnings and hopefully earns fast enough to make all its money back. And that's what this ratio is essentially explaining. It also says that what it trades in this range of, say, 20 times to 15 times enterprise value to EBITDA. With most recent highs at 20x, kind of the low being 15 over the last 9 years. Average is 17.8. Let's take a look at cash flow and see how much hard money these guys make running their business. Okay, let's take a look at cash flow. Now, before we do that, I want to take a pause, actually hit the subscribe button, hit the like button. I really appreciate any shares on social media. Also, down below in the link, there's a description of my website, cashflowinvestingpro.com, where I teach a course on how to do exactly what I'm doing right now. All right, let's keep going. Cash flow from operations. Now, what is cash flow from operations? Cash flow from operations is exactly what it says. It's the cash, money, made by operating the business. There are 3 sections of the cash flow statement: cash flow from operations, cash flow from financing, cash flow from investing. The first third is the cash flow from operations. That's what we're looking at here. That's what this number is. It's the hard jack that's left in the bank account after the year's done. How much money do they make? Actual cash, not earnings, not fakeness. This is pure cash money. That's what we want to find out. And they had $18 billion of jack in 2013, $90 billion, almost $100 billion of pure cash from running their business. That's cloud, that's search, that's selling Androids, it's all of it, it's YouTube, it's everything piled up. And what I like about this is it grows every year. It is also very consistent with EBITDA, 22% annualized growth rate here, and I had a 21% annualized growth rate there. That means the accounting team is expensing properly when it comes to the cash that's running through the business. Great job, guys and girls. I really appreciate that. Thank you so much. All right, here we go. CAPEX. CAPEX is the capital investment, CAPEX, or capital expense, that's put back in the business to replenish what is used. If it's machinery, you're changing the belts, the tires, and so forth. For Google, it's probably server farms, computers that they need to upgrade and maintain, buildings, infrastructure, building a new building for all the people to move into or work remote. So anyways, $24 billion is what they put back in the business. So basically, at the end of the year, $91 billion piles up in the cash on the bank. They're like, what should we do with this money? I don't know. Let's put some back into infrastructure. Okay, here's $21 billion. Whoop, put that off. The amount of money that they make here easily pays for the capital investment that they have to put back. So after this is done, there's still $64 billion to $66 billion of cash still sitting in the bank. What do they want to do with it? Well, the next thing that you have to do is you pay down debt. Well, they have no debt. Oh, well, that was easy. Okay, then the next thing, oh yeah, pay the equity owners. That's us. That's you. That's me. That's the people who buy the stock. That's exactly what you're buying. So this flows through the debt. Debt is relatively zero. They paid $1.2 billion, which is a rounding error for Google last year in debt. Free cash flow to equity. That is exactly what we want to find. That's $65 billion. And this number has gone up every single year because they continue to grow earnings. CAPEX is always reasonable and affordable. Even though it grows with this margin still intact. They have zero debt. All this flows through to the equity owners. You have the shares outstanding here, 678 million shares outstanding. Basically flat over this time. So you're taking this number here, which is total cash, $65 billion, divided by 678 million shares, and you get free cash flow per share. Now, every time you buy a single share of stock, this is your pro rata ownership of the cash flow that the business generates. And this is what the stock is valued on. Now, here's the stock price. $540 a share to $2,900 a share, and I'll give you a cash flow yield off to the side. On the low end, we're talking 3.2, high end 4.5. That's the cash flow breakdown. It is strong, it is growing. Great job, Google. Love to see that. All right, now the time comes to grow the stock. And I want to remind you of my course down below. Please take a look at it where I give you this financial model. We go through Apple Corporation. I give you 10 years of 10Ks, and we really work through how to do this, and I teach you how to be an analyst for yourself. $100 billion of EBITDA is my forecast for next year. Now, we just saw the Q1 earnings where revenue is up 23% year over year for the quarter. Now, I still think they're going to continue to grow. They could even grow earnings 20%, but I'm going to hedge my bets because the market is crazy right now. So I'm going to give it 10% growth out next year, and I'm going to say they're going to do 5% outgrowing going forward because, frankly, these numbers are so big. I find it hard to believe that a company can produce $100 billion of earnings, yet grow that continuously at 20% like they've been doing. So I'm going to say for me to put money in this business, I want a nice conservative forecast. I want a low multiple. I want to build as much moats around this business as I can before I put $1 in. And then if it still has a high market-beating IRR after doing this, then I think it's an interesting investment. So let's keep going. The long-term forecast here is $155 billion by simply growing at 10% and 5%. I'm going to apply a 15% market multiple to that. That's going to give me an enterprise value of $2.3 trillion out 10 years from now. I have a little bit of debt. I still have lots of cash. Market cap, $2.4 billion. I keep the shares outstanding the same, 677 million shares, and I got a long-term price target of $3,575 for Google per share. Now let's do the same thing for free cash flow. Free cash flow is $108 a share next year, following the 10% growth, followed by 5% after that, which gives me $168 of free cash flow out 10 years from now. I apply a 4 times free cash flow yield multiple to that, and I get $4,218 of a long-term price target using the free cash flow per share method. Okay, now what do? We have 2 price targets, right? We've got one where he said free cash flow method is producing $4,218 a share. I've got a market multiple, EBITDA market multiple, of $3,575 a share. I'm going to split the difference, call it 50-50, and say it's $3,897 out 10 years from now. Now is the point when we look into the market to see what we can buy the stock for. Don't ever look at the stock price before you do your analysis. Come to your own conclusion, how much you would pay for stock, then look to see what the stock market's paying. Because remember, the stock market is by no means rational. It's by no means efficient. It's wildly inaccurate at some points. So you want to come to grips with what you believe the stock is worth. Then go look out into the market and see if it's valued. So I look out in the market and I get $2,150. I can buy as much shares as I want. I think it's worth almost $4,000 out 10 years. In terms of current multiples, right? So the current market cap at today's price, which is this, is $1.3, $1.4 trillion of market cap. Interestingly, based on my forecast of $100 billion of EBITDA next year, that's only a 13.6 market multiple. So here's something interesting. The market multiple we're using out long-term is 15%. If I look out historically, in terms of the range of multiples, that's one of the lowest multiples in the last 9 years is what I'm using out 10 years. And it's currently trading at 13 times. 13 times at a 5% yield. Same story with the yield. This is the highest yield they've had in 10 years as well, at least on an annual basis. So what does that give us? That gives us a trifecta opportunity here, which is very, very interesting. You would not expect Google to reach a trifecta. Here on the channel, we call a trifecta a stock that has earnings growth, a share buyback program, and a market multiple expansion opportunity. And right now, if you can buy this at 13.6 times and sell it 10 years from now at 15 times, that's an expanded market multiple. Even if it's small, it's still an expansion. All right, let's drop this into our IRR calculation and see what we're going to get. So here we are, the IRR calculation. I got my stream of cash flow, my pro rata shares that I own of free cash flow. I'm in it for $150. I'm out for just under $4,000 out 10 years from now. And what does that give me? It gives me 13% IRR, which is a market-beating return on a very conservative growth forecast. If I look at this forecast, and I think that they were doing 21% growth rate in EBITDA annually, a consolidated annual basis over the last decade. I'm saying 10% and then 5% out in the future, which I think is conservative and they can beat it. And under those circumstances, the stock is still yielding a market-beating return. I think that's the definition of a good stock. Let's review the 5 key attributes and see how it shakes out. Number 1, top line revenue growth. You bet yourself it's growing. Number 2, EBITDA, yes, strong and growing. Number 3, strong free cash flow, yes. Number 4, low debt, it's 0. And number 5, well priced, yes, we think it's well priced. It's well priced because, as I just mentioned, a conservative forecast, a conservative market multiple, and it's still producing a market-beating return. That, my friends, is a good stock to do more research on and to figure if it's right for you. But I like that. That's what we're doing here. Now let's put this into a matrix because, as you know, this market is wild, and you can always take a look back in my past videos to see what the stock is yielding at different prices. So here we are today. Based on the current forecast that I just showed you, it gives me a 13% return. If this market continues to fall, which I do think it's going to, market is fundamentally changed forever if the Fed holds their policy and continues to ratchet rates. They just moved rates up 75 bips. Now that's a big deal. There's a lot of companies out there that are leveraged, and their leverage contracts have floors on them, meaning when rates were 0, the interest rate stopped, say, at 1 or 1.5%. And they paid the 1.5% even though rates were 0. And then as rates come up, there's a grace period where the rate increases doesn't affect them because the floor in their debt is, say, 1%. But then as the interest rates, the Fed funds, crosses 1%, suddenly every basis point move by the Fed is a pro rata knock on the interest rate for the company, which means higher interest expense and lower earnings per share for the companies that are highly leveraged. So I really want to challenge you, go through your financial statements, make sure there's very little debt on the companies that you own. So here we are, 13%. Now if the stock falls, which I just said in my tangent, and I think it's going to, as it comes down, I think the stock return gets even better, and I would be a buyer. I'd be buyer all the way down for this company because I think it's actually a really nice company. Even if it goes up a little bit, I still like it. I think the forecast is conservative enough to where it's a very attractive investment given everything going on in this market. Okay, this is Alphabet Google. I want you to take a minute and just thank all the participants of the Cash Flow Club. What is the Cash Flow Club? Well, I can only do a video once a week, but I do release my one-pagers, countless of them, every week, every month into the Cash Flow Club. And it's a one-pager. It's what I call it. It's a one-pager. It's a one page that summarizes 10 years of historical financials for the companies that we review. Just like we did here, revenue, EBITDA, debt, cash flow. I give you a forecast based on the 2 market multiples. You get your IRR summary, and over here you get the 5 key factors summarized. I give you a blurb on what I'm thinking the company's doing in the future, and a chart just to give you some visualization. I'm throwing these things out as fast as I can. We're getting analysts into the group, and we're really cranking away. And I would challenge you to do your own work. If you think you're going to get a wild deal by going into seeking alpha, well, so are millions of other people. If you're on Yahoo Finance and looking at that data or buying on the buy recommendation that those guys have, millions of other people are. You have to do the work, unfortunately. And you can either read the 10Ks or you can go to people who are reading the 10Ks like we are and try to find some unique pieces of data that you can use to outperform the market. You're not going to get it by going to the same screens everybody else is going. You're just not going to do it. So in the link below, you can see a free one-pager if you click on the Cash Flow Club. You can also go click on the Cash Flow course. My website is cashflowinvestingpro.com. You can check out that course, and in that course, you will be able to get this Excel sheet. I walk you through how to view and value Apple. I teach you how to read 10Ks. You get 10 years worth of Apple 10Ks. We build a forecast. We talk market multiples. I talk you through share buyback programs, how to adjust for splits, and I teach you how to be a financial analyst. And I'm telling you, you can do this yourself. And if you did a little bit of work in an area that you already know something about, don't go wandering off into biotech. But if you know consumer products or you're in a shipping world and you know shipping companies, you can focus in something that you know and make very good money. So I would encourage you, check out the course, check out the Cash Flow Club, get the free one-pager down below in the link, and don't forget to hit the subscribe button or the like button. I really appreciate the thumbs up. This is Rational Investing, where we dive into cash flow and figure out how much money these companies really work. Also, throw a comment down below. A lot of value investors are tossing comments down below. In the Cash Flow Club, by the way, we just reviewed Paramount. We just reviewed Agrico. We just reviewed a number of stocks that are surprisingly cheap and doing really well. Sleep Number. I mean, these stocks are yielding 20-something% IRRs for a decade. I can't do every stock in YouTube, and people only search for the top stocks like Google and Facebook, everything else. But the real money is going to be made in these one-off brand names that I'm throwing in the Cash Flow Club. Definitely check it out, guys. I really appreciate the support. Okay, here we go. Thank you very much. This is the end. Up pop is going to pop a couple more value companies if you want to see other videos I've done. I really appreciate the support. Thank you very much. Have a great day. Bye-bye.